Most investors think finding the next winning stock is all about chasing the biggest headlines. They look at soaring share prices, record-breaking earnings, and the companies dominating every conversation about artificial intelligence. And on the surface, that strategy seems to make perfect sense. After all, the US stock market has climbed to historic highs. Major indexes have delivered one of their strongest first halves in years, and the AI revolution continues to fuel optimism across Wall Street. It feels like the easiest investment decision in the world. But that's only half the story. Because while the headlines celebrate record highs, the smartest investors are paying attention to something entirely different. Behind the scenes, interest rates remain restrictive. Inflation is proving more stubborn than expected. Job growth is beginning to slow, and institutional investors are becoming far more selective about where they put their money. In other words, this isn't a market where simply buying an AI stock is enough anymore. The real opportunity lies in understanding which companies are actually positioned to thrive in this new environment, and why. Some businesses are benefiting from structural advantages that most investors rarely notice. Others are trading at valuations that already assume everything will go perfectly. And a few are quietly building the infrastructure that could determine who wins the next phase of the AI boom. In this video, we're going beyond the headlines. We'll examine the macroeconomic forces shaping today's market, uncover what Wall Street analysts, hedge funds, and corporate insiders are doing with their own money, and break down the companies that stand out. Not because they're the most popular, but because their fundamentals tell a much more compelling story. By the end of this video, you'll have a clearer understanding of where the biggest opportunities may exist, where the risks are hiding, and why the stocks attracting the smartest money today might not be the ones making the loudest headlines. The market looks strong, but that's exactly why investors should be careful. If you only looked at the major stock indexes, you'd probably think the US market is firing on all cylinders. The S&P 500 has posted one of its strongest first-half performances in years. The Nasdaq continues pushing higher as artificial intelligence dominates investor attention. On paper, it's the kind of environment that makes buying stocks feel almost effortless. But markets rarely reward what's obvious. History has shown that some of the biggest investment mistakes happen when optimism reaches its peak. And today's market is filled with contradictions that most investors aren't paying enough attention to. On one hand, corporate earnings remain resilient, AI infrastructure spending continues to accelerate, and investors are celebrating record highs across many of the market's biggest names. On the other hand, several warning signs are quietly becoming impossible to ignore. Inflation remains stubbornly elevated, forcing the Federal Reserve to maintain a restrictive monetary policy. Instead of signaling easier financial conditions, policymakers are indicating that interest rates could stay higher for longer than many investors had expected. That changes everything. Higher interest rates increase borrowing costs for businesses, reduce the value of future earnings, and make investors much more selective about where they allocate capital. At the same time, the labour market is beginning to cool. Job creation has slowed significantly compared to expectations. While unemployment remains relatively stable, weaker hiring suggests that the economy is gradually losing momentum. It's not a recession, but it's certainly not the kind of environment where every company can continue growing at the same pace. Then there's another signal that's even easier to overlook. Investor sentiment. Despite record-breaking stock prices, fear hasn't disappeared. Instead of showing extreme optimism, many professional investors are becoming increasingly defensive. Volatility remains elevated, and institutional traders have been increasing protective positions rather than aggressively chasing the rally. That tells us something important. The market isn't climbing because investors believe every stock is undervalued. It's climbing because capital is flowing into a very small group of companies with exceptionally strong fundamentals. And that's a critical distinction. This is no longer a market where average businesses receive premium valuation simply because they're associated with artificial intelligence. Investors are demanding something much more valuable. Predictable cash flow, strong balance sheets, pricing power, long-term customer contracts, and business models capable of generating consistent profits even if economic conditions become more challenging. In other words, the market has shifted from rewarding exciting stories to rewarding durable businesses. That shift explains why some companies continue attracting billions of dollars in institutional capital, while others struggle to justify their valuations despite operating in the same industry. And once you understand what professional investors are actually looking for, the next question becomes far more interesting. If money isn't simply chasing AI anymore, where is the smartest money actually going? That's where the story takes an unexpected turn. Follow the smart money, because that's where the real story begins. When markets become uncertain, headlines become less useful. The companies dominating financial news aren't always the ones attracting the most conviction from professional investors. And that's why experienced investors pay close attention to something else entirely. They follow the money, not the opinions, not the predictions, the actual capital being deployed by Wall Street's biggest institutions. Because when billions of dollars are on the line, every investment decision reflects months of research, financial modelling, and risk analysis. These firms aren't chasing hype. They're positioning for what they believe will matter over the next several years. And this year, their behaviour reveals a fascinating shift. Instead of spreading investments across dozens of companies, many of the world's largest investors are becoming increasingly selective. They're concentrating capital into businesses with durable competitive advantages, while reducing exposure to companies whose future depends on perfect economic conditions. One of the clearest examples comes from Berkshire Hathaway. Under its new leadership, the company has dramatically streamlined its investment portfolio, reducing the number of holdings while continuing to sell more stocks than it buys. That isn't the behaviour of an institution expecting an easy market. It's the behaviour of one preparing for a market where quality matters far more than quantity. Other hedge funds are sending similar signals. Bill Ackman's Pershing Square made Microsoft its newest major position, reinforcing the belief that enterprise AI, not speculative AI startups, could become one of the biggest long-term winners. Meanwhile, technology-focused firms like Tiger Global and Coatue continue increasing exposure to critical semiconductor infrastructure, adding positions in companies that supply the hardware powering the AI revolution. Notice the pattern. They're not buying every company with AI in its marketing. They're buying the businesses that make AI possible, the companies manufacturing chips, building servers, expanding cloud infrastructure, providing high-speed networking, and storing the enormous amounts of data modern AI systems require. It's a classic example of what investors often call the picks and shovels strategy. During the California gold rush, fortunes weren't always made by the people searching for gold. Many were made by the businesses selling the tools everyone else needed. Today's AI boom is beginning to look remarkably similar. Every new language model, every new data center, every new AI application depends on an enormous physical infrastructure operating behind the scenes. That means the biggest opportunities may not belong to the companies creating AI software. They may belong to the companies supplying the memory chips, storage systems, networking equipment, and energy infrastructure that every AI company depends on. And institutional investors clearly understand that distinction. But there's another group whose actions deserve just as much attention: corporate insiders, the executives who know their own businesses better than anyone else. Interestingly, many insiders at some of the market's largest technology companies have recently been selling significant portions of their shares. While insider selling doesn't automatically signal trouble, it can happen for many personal reasons. It does suggest that some executives are taking advantage of historically high valuations. At the same time, selective insider buying is appearing in companies where executives believe the market may be underestimating future potential. Taken together, these signals paint a very different picture from the headlines. The smartest money isn't blindly chasing momentum. It's becoming far more disciplined. It's looking for businesses with predictable cash flows, strong pricing power, resilient balance sheets, and competitive advantages that can survive even if economic conditions become more challenging. And once you apply those filters, the list of attractive companies becomes much smaller. In fact, one company stands out for a reason most investors still don't fully appreciate. At first glance, it looks like just another semiconductor manufacturer. But beneath the surface, its business has changed in a way that could fundamentally alter how investors should value it. And that's where our first stock enters the story. Micron isn't just selling memory anymore, it's selling predictability. For years, Micron technology lived with a reputation that investors know all too well. It was considered a cyclical semiconductor company. When demand for memory chips surged, profits exploded. But when supply caught up, prices collapsed, margins shrank, and investors quickly moved on. It was a business known for dramatic highs and equally painful lows. That reputation defined Micron for decades, but according to the latest research, that narrative is beginning to change, and it may be one of the most important shifts happening in the semiconductor industry today. The common assumption is that Micron's future still depends on the unpredictable pricing of memory chips. The reality is much more interesting. Instead of relying solely on the volatile spot market, Micron has been restructuring its business around long-term strategic customer agreements, multi-year contracts with some of the world's largest technology companies. These agreements aren't just purchase orders. They create long-term visibility into future demand, secure financial commitments from customers, and reduce the uncertainty that has historically defined the memory business. In total, Micron has signed 16 long-term strategic customer agreements, covering a significant portion of its expected DRAM and NAND production through the end of the decade. Even more importantly, those agreements are backed by approximately $22 billion in customer commitments and cash deposits, providing a level of stability the company simply didn't have in previous industry cycles. That's a fundamental transformation, and the financial results suggest it's already making a difference. In its latest reported quarter, Micron delivered results that didn't just beat expectations, they surpassed them by a remarkable margin. Revenue climbed to more than $41 billion, dramatically exceeding analyst forecasts. Profitability reached extraordinary levels, with gross margins approaching 85% and net margins exceeding 68%. Operating cash flow surged, while free cash flow remained exceptionally strong. At the same time, the company's balance sheet continued to strengthen, with cash reserves significantly outweighing long-term debt. Those aren't the numbers of a company struggling to survive the next downturn. They're the numbers of a business benefiting from one of the strongest demand environments in its history. And that demand isn't coming from smartphones or personal computers, the markets that once defined Micron's business. It's coming from artificial intelligence, more specifically from high bandwidth memory, or HBM. Modern AI accelerators process enormous amounts of information simultaneously, creating an unprecedented need for ultra-fast memory capable of keeping up with increasingly powerful GPUs. Without that memory, even the world's fastest AI chips can't operate at their full potential. That's why Micron's latest HBM products have become one of its biggest competitive advantages. Demand has become so strong that according to the company's outlook, production for 2026 is effectively committed, giving management unusual confidence in future revenue and earnings. But here's what makes Micron especially interesting. Despite these operational improvements, the market still values the company as if it were the old Micron. Its forward valuation remains well below many technology peers, even though its business model has become significantly more predictable. In other words, investors appear to be pricing Micron based on yesterday's risks rather than today's reality. Of course, no investment is without uncertainty. The company still faces potential legal challenges, including antitrust litigation involving memory pricing. Future trade restrictions or weaker than expected demand for AI infrastructure could also affect growth. And memory remains a competitive industry where supply expansions from rivals could eventually pressure pricing. Those risks deserve serious consideration, but they don't erase the bigger picture. Micron is no longer simply participating in the AI boom. It's becoming one of the companies supplying a critical component that every advanced AI system depends on. And that's exactly the type of structural advantage institutional investors have been searching for. But if Micron represents the evolution of memory technology, the next company takes that story one step further. Because instead of competing across multiple markets, it has focused almost entirely on one opportunity, and that strategy has turned it into one of the market's most surprising winners. SanDisk's biggest advantage isn't its technology, it's its business model. If Micron represents a company that's reinventing itself, SanDisk represents something even more unusual. A company that quietly positioned itself at the center of one of the fastest growing segments of the AI economy, without attracting nearly the same level of attention as the industry's biggest names. Most investors still associate SanDisk with consumer storage products. Flash drives, memory cards, portable SSDs. But that's no longer the business driving its future. Today, the company's biggest opportunity lies inside AI data centers, because every breakthrough in artificial intelligence creates another problem: storage. Training large language models isn't just about processing data. It's about storing unimaginable amounts of it. Every prompt, every dataset, every model update, every enterprise application generates and retains enormous volumes of information that must be accessed quickly, securely, and continuously. As AI systems become more powerful, demand for enterprise-grade storage doesn't grow linearly. It accelerates. And that's exactly where SanDisk has built its competitive advantage. Unlike many storage companies that compete across multiple categories, SanDisk has become a pure-play NAND flash company focused on high-performance enterprise storage. That focus matters, because specialized businesses often move faster, allocate capital more efficiently, and respond more quickly to shifts in customer demand. But the technology itself isn't what makes SanDisk so compelling. The real story is hidden inside its contracts. Most investors assume storage companies rise and fall with fluctuating memory prices. Historically, that's been true. When supply exceeded demand, prices collapsed, profits disappeared, and entire cycles repeated themselves. SanDisk has tried to reduce that risk in a remarkably simple way. Many of its long-term agreements include a contractual minimum price floor for NAND storage. In other words, even if market prices weaken in the future, those agreements help protect the company's profitability. That's a powerful advantage in one of the semiconductor industry's most volatile markets. It transforms uncertainty into visibility. And investors have started noticing. The company's recent financial performance reflects exactly that. Revenue significantly exceeded expectations. Earnings came in far above analyst forecasts. Profit margins expanded dramatically. Its enterprise data center business delivered exceptional sequential growth, supported by continued demand for high-capacity storage solutions built specifically for AI infrastructure. At the same time, SanDisk continues developing products aimed directly at the next generation of AI computing. Among its newest offerings are enterprise SSDs, with capacities reaching 256 terabytes, designed to handle the enormous storage requirements of modern AI data centers, and large-scale cloud infrastructure. That isn't simply a larger hard drive, it's infrastructure designed for an entirely different era of computing. Wall Street has taken notice as well. Most analysts covering the company maintain positive ratings, with several firms substantially increasing their price targets after reviewing the company's latest results and long-term outlook. Their reasoning isn't based on temporary momentum. It's based on the belief that the imbalance between supply and demand for enterprise NAND storage could continue well beyond the current cycle. Of course, no competitive advantage lasts forever. SanDisk still faces meaningful risks. If new manufacturing capacity enters the market faster than expected, pricing pressure could eventually return. Competition from major global memory producers remains a long-term concern. And like every company benefiting from today's AI investment cycle, its outlook depends on continued infrastructure spending across the technology industry. Those risks shouldn't be ignored, but they also don't erase what makes SanDisk unique. While much of the market focuses on companies creating artificial intelligence, SanDisk is helping solve one of AI's biggest physical limitations, because intelligence isn't useful if the underlying data can't be stored, retrieved, and delivered at scale. And that's why the company has become one of the clearest examples of the modern picks and shovels investment strategy. But if Micron supplies the memory and SanDisk stores the data, the next company sits even higher in the AI ecosystem. In fact, without it, much of today's AI revolution simply wouldn't exist. Nvidia is still dominating AI, but that's not the most interesting part. If there's one company that has become synonymous with artificial intelligence, it's Nvidia. Mention AI investing almost anywhere in the world, and chances are Nvidia is the first name people bring up. And honestly, it's easy to understand why. Its graphics processors have become the foundation of modern AI computing. From training massive language models to powering cloud infrastructure and enterprise AI applications, Nvidia's hardware sits at the center of the industry's biggest technological shift in decades. But here's the mistake many investors make. They think Nvidia's success is simply about selling more GPUs. According to the research, the real story is much bigger than that. Nvidia isn't just building chips, it's building an ecosystem. And that distinction may explain why the company continues to stay several steps ahead of its competitors. The common expectation is that AI demand eventually slows as more companies enter the market. But Nvidia's strategy suggests it's preparing for exactly the opposite. Its data center division has become the engine driving the entire business, generating the overwhelming majority of company revenue. And that engine is still accelerating. In its latest quarter, revenue surged once again, with the data center business accounting for nearly all of the company's growth. Even more impressive, the networking division delivered extraordinary expansion, demonstrating that Nvidia isn't only benefiting from demand for processors, it's also supplying the networking infrastructure that allows thousands of GPUs to communicate efficiently inside modern AI data centers. That's an important difference. Because building an AI supercomputer isn't as simple as stacking thousands of graphics cards together. Every processor must exchange enormous amounts of information with every other processor in real time. Without high-speed networking, the entire system becomes a bottleneck. By expanding beyond GPUs into networking infrastructure, Nvidia is capturing a much larger share of every dollar spent on AI data centers. But perhaps the strongest evidence of Nvidia's long-term strategy isn't found in its income statement. It's found in where the company is investing. According to the research, Nvidia has significantly increased its ownership in cloud infrastructure companies while also investing in suppliers of critical optical and photonic components. At first glance, those investments might seem unrelated. In reality, they're solving one of AI's biggest future challenges. As AI models become larger and data centers become more complex, moving data efficiently becomes just as important as processing it. In other words, Nvidia isn't waiting for infrastructure problems to appear. It's investing in the companies that can solve them before they become constraints. That's a remarkably different strategy from simply maximizing quarterly profits. It's about strengthening the entire AI ecosystem that its own business depends on. And demand doesn't appear to be slowing. The world's largest hyperscale technology companies, including Amazon, Microsoft, Alphabet and Meta, are collectively planning hundreds of billions of dollars in AI infrastructure spending over the next 2 years. Every new AI data center, every GPU cluster, every enterprise deployment represents another opportunity for Nvidia to expand its leadership. That helps explain why Wall Street continues viewing the company so favorably. Despite trading at a higher valuation than many traditional hardware businesses, analysts argue that its extraordinary earnings growth justifies the premium. The market isn't paying for today's profits alone. It's paying for Nvidia's ability to remain at the center of tomorrow's AI economy. Of course, leadership doesn't eliminate risk. Export restrictions on advanced semiconductor technology remain a significant uncertainty. Regulatory scrutiny continues to increase as governments examine the growing concentration of power within the AI industry. And if enterprise AI spending eventually slows, Nvidia would almost certainly feel the impact. These are real risks. But they don't change one important conclusion. Nvidia has evolved beyond being a semiconductor company. It's becoming the architect of the AI infrastructure ecosystem itself. Yet even that isn't the final piece of this investment puzzle. Because while companies like Nvidia, Micron and SanDisk supply the technology inside AI data centers, someone still has to build the physical infrastructure that keeps those facilities running. And that brings us to one of the market's most unexpected beneficiaries of the AI revolution. The real opportunity isn't following the hype. It's understanding what drives it. At the beginning of this video, we asked a simple question. What are the best stocks to invest in right now? At first, the answer seemed obvious. The market is sitting near record highs. Artificial intelligence continues to dominate headlines. And every week, another company claims to be leading the next technological revolution. But after looking beneath the surface, a very different picture begins to emerge. The biggest opportunities aren't necessarily found in the loudest headlines. They're found in the companies building the foundation that makes the AI revolution possible. Companies with durable competitive advantages, long-term customer relationships, strong free cash flow, healthy balance sheets, and business models designed to perform even in a more challenging economic environment. That's why businesses like Micron and SanDisk stand out, not simply because they produce memory and storage, but because they're transforming traditionally cyclical businesses into more predictable, contract-driven operations. It's why Nvidia continues to command such extraordinary attention, not just because it builds the world's leading AI chips, but because it's positioning itself at the center of the entire AI infrastructure ecosystem. And it's why Caterpillar reminds us that some of the biggest beneficiaries of technological revolutions don't always look like technology companies at all. Sometimes the companies providing the power, equipment, and physical infrastructure become just as important as the companies writing the software. But perhaps the biggest lesson from this entire analysis has nothing to do with any single stock. It has to do with how markets evolve. As easy money disappears and economic conditions become more selective, investors can no longer rely on exciting narratives alone. The market is becoming increasingly disciplined. It's rewarding companies with real earnings, real cash flow, real pricing power, and business models capable of delivering results long after the excitement fades. That doesn't eliminate risk. Interest rates remain uncertain. Geopolitical tensions continue to shape global markets. Competition is intensifying. And today's winners will still need to prove they can justify the expectations already reflected in their valuations. But history has shown that periods like these often separate exceptional businesses from simply popular ones. And for long-term investors, that distinction can make all the difference. So instead of asking which stock has generated the biggest headlines, it may be more valuable to ask a different question. Which companies are quietly building the future that everyone else is talking about? Because in investing, the biggest winners aren't always the companies attracting the most attention. More often than not, they're the ones building the infrastructure that makes every headline possible. If you enjoyed this deep dive and found it valuable, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss our next documentary. And as always, thanks for watching. We'll see you in the next one.